Welcome to Pacific States University's online lecture series for BBA 302, Economics for Business. Today, we are diving into monetary policy and interest rates. If you've ever listened to the financial news or even just scrolled through your feed, you've probably heard reporters intensely debating what the central bank is going to do next with interest rates. Will they raise them? Will they cut them? Will they keep them the same? And you might have found yourself wondering, how does a decision made in a boardroom in Washington actually impact the everyday economy? How does it affect your ability to get a car loan, or buy a house, or even land a job after graduation? Well, you are in exactly the right place today. In this lecture, we are going to build a comprehensive, foundational understanding of how the invisible levers of monetary policy are pulled, how they ripple through complex financial markets, and ultimately, how they steer the real, everyday economy that we all live in. Let's get started.
So let's contextualize where we are in our coursework. In our previous sessions on macroeconomics, we firmly established the main goals of any healthy functioning economy. We're looking for robust, sustainable economic growth. We want low unemployment so people have jobs and incomes, and we need low, stable inflation so that money holds its value. But as you'll quickly learn in economics, simply knowing the goals is very, very different from knowing how to actually achieve them. Today, we are moving past the goals and focusing strictly on the macroeconomic mechanisms. These are the actual tools that governments and central banks use to support the massive interlocking system of money, loans, and banking. It's like the plumbing of the economy. If this system falters, if the pipes get clogged or burst, an economy can easily spiral into a devastating recession where jobs disappear, or on the flip side, it can suffer from prolonged runaway inflation where your savings become worthless. We are going to demystify exactly how central banks attempt to prevent those absolute disasters and actively influence the broader economic landscape.
Here is our roadmap for today's lecture. 1. The Federal Reserve System. 2. Tools of monetary policy. 3. Impact on interest rates. 4. Expansionary versus contractionary policy. And finally, 5. Pitfalls of monetary policy.
All right, let's jump right into Section 1, the Federal Reserve System.
Behind the heavy doors of the Mariner S. Eccles headquarters in Washington, D.C., which you can see right here on the slide, some of the world's absolute most influential economic decisions are made. To truly understand this immense power, we actually have to look all the way back to the foundation of the country. Article 1, Section 8 of the U.S. Constitution specifically gives Congress the power to coin money and to regulate the value thereof. For a long time, Congress handled this directly, but eventually the economy became far too complex. So in 1913, Congress officially delegated these immense constitutional powers to the newly created Federal Reserve, which we commonly just call the Fed. Now, what is the Fed actually doing every day? Their most prominent task is conducting monetary policy to achieve what is widely referred to as its dual mandate. This is absolutely crucial to remember. The dual mandate is essentially a balancing act. They are legally required to pursue both low unemployment and low inflation. Now, here's a really fascinating part of the system's design. Unlike fiscal policy, which involves taxes and government spending driven by elected politicians and can change drastically every time a new administration takes office, the Fed is specifically designed to have a significant degree of political independence. The Board of Governors isn't running for re-election. This structural independence is incredibly important because it allows the Fed to make highly technical, objective, and data-driven decisions based purely on long-term economic grounds rather than short-term political popularity. Moving on to Section 2, Tools of Monetary Policy. Let's look at the actual levers they pull. The single most critical concept for you to grasp in this entire lecture is the federal funds rate, often abbreviated as the FFR. By definition, this is the specific interest rate at which one bank lends funds to another bank overnight. Let's break down why this happens. By law, banks are required to hold a certain amount of physical reserves at the end of every single business day to ensure they remain solvent. But banking is unpredictable. At 5 p.m., some banks might find they have excess cash sitting around, while others realize they are slightly short of their legally required reserve amount. So what do? They turn to the federal funds market. This is an exclusive interbank market where these institutions borrow and lend to one another overnight to balance their books. The Federal Open Market Committee, or FOMC, the main policymaking body of the Fed, makes it their primary mission to target this specific overnight rate. But why? Why does the central bank care so much about what banks charge each other for a 12-hour loan? Because this foundational rate creates a massive ripple effect across the entire global economy. It's essentially the wholesale cost of money. As the federal funds rate changes, almost every other interest rate you interact with, like your 30-year mortgage, your auto loan, the interest on your credit card, and the rates businesses pay to build new factories, eventually move in tandem. So the Fed manipulates the overall supply of bank reserves in the system to push this specific overnight rate up or down to hit their desired target, which then dictates the cost of borrowing for everyone else.
But we have to ask, what happens during a really severe economic downturn? Imagine the economy is in a free fall, and the central bank reacts by aggressively pushing the federal funds rate down to stimulate growth. Eventually, they hit a floor. Once they drop that overnight rate to essentially 0%, they can't realistically go any lower. You can't really have negative interest rates where the bank pays you to borrow money, right? At the zero lower bound, traditional monetary policy is effectively maxed out. They are out of standard ammunition. To overcome this major limitation, the Fed developed an innovative, non-traditional tool called quantitative easing, or QE. Instead of just targeting those short-term overnight rates, which are already at zero, the central bank decides to go shopping. They buy up massive, unprecedented amounts of long-term government securities and private mortgage-backed securities from the open market. By purchasing these financial assets, the Fed literally creates money out of thin air to pay for them, which pumps vast amounts of newly created cash directly into the financial system. This action clears out the clunky assets from bank balance sheets, replacing them with cold, hard cash. The goal here is to free up the banks, making credit widely available and cheap, which hopefully stimulates aggregate demand. It is a very powerful, heavy-handed way to shock the economy back to life when traditional, subtle interest rate levers have gone as far as they can go.
Let's move to Section 3, Impact on Interest Rates. We'll look at the exact mechanics of how this works on a graph.
Now, let's apply a little microeconomic graphing to our macroeconomic problem. Let's look at how this manipulation actually plays out in the market for loanable bank funds. Take a close look at this graph. On the vertical axis, we have the interest rate. That's the price of borrowing money. On the horizontal axis, we have the quantity of loanable funds. We start with a standard downward-sloping demand curve and an upward-sloping supply curve, meeting at an initial equilibrium. Now imagine the central bank wants to expand the economy. They intervene by increasing the total amount of bank reserves in the system. Notice how this action literally shifts the entire supply curve of loanable funds over to the right. What is the mathematical results of that rightward shift? The new equilibrium settles at a lower point on the y-axis, meaning interest rates drop. And it settles further to the right on the x-axis, meaning the overall quantity of loaned funds in the economy expands. Money is cheaper and more plentiful. Conversely, think about what happens if the Fed decides the economy is running a bit too hot and they want to cool things down. They will deliberately reduce bank reserves. This shifts that supply curve back over to the left. That leftward shift pushes the equilibrium interest rate higher, making borrowing more expensive, and consequently, it restricts the overall quantity of loaned funds available to businesses and consumers. The Fed will continuously monitor the data and actively supply more or fewer reserves into this market until that resulting equilibrium interest rate precisely hits their stated target. It's a constant, active calibration.
Section 4, Expansionary versus Contractionary Policy. This is where we look at the big picture strategy.
The guiding principle you need to understand is that central banks almost always act countercyclically. That means they are intentionally pushing against the prevailing winds of the business cycle to smooth out the extreme highs and the extreme lows. First, let's talk about expansionary, or what financial markets often call loose monetary policy. This strategy is deployed when the broader economy is sluggish, unemployment is creeping up, and we are either entering or in the middle of a recession. By actively lowering interest rates, the Fed makes borrowing significantly cheaper. This acts as an economic stimulant. It encourages businesses to take out loans to invest in new equipment or hire more workers, and it encourages consumers to take out mortgages or put purchases on their credit cards. All this new spending pulls the economy out of its slump. On the exact flip side, we have contractionary, or tight monetary policy. Think about a scenario where the economy is running a little too hot. Everyone is spending, demand is outstripping supply, and consequently, inflationary pressures start to build up dangerously fast. Prices are skyrocketing. To combat this, the central bank raises interest rates. This makes borrowing painful and expensive. As a result, businesses delay expansions, consumers hold off on buying new cars or homes, and overall spending drops. This intentional reduction in aggregate demand cools off the overheated economy and brings inflation back down under control. It's literally the central bank stepping on the brakes of the economy.
Let's trace this complete, logical chain reaction using the pathways flowchart on the screen. This brilliantly summarizes everything we've talked about so far. Let's follow the top path for an expansionary policy. The central bank acts to increase the money supply. As we saw in our graph, a higher supply of money naturally lowers the equilibrium interest rate. That cheaper cost of borrowing directly drives up business investment and household consumption. Because investment and consumption are massive components of aggregate demand, this surge ultimately increases real GDP and pulls the whole economy forward out of a recession. It's a neat, logical sequence. Now follow the bottom path. The exact reverse happens for contractionary policy. The central bank intentionally restricts the money supply. Less money available raises the interest rate. That higher cost of borrowing leads directly to a reduction in business investment and a drop in household consumption, which decreases aggregate demand. That drop in demand is what ultimately tames rising inflation. But I want you to pay very close attention to a massive caveat here. It's absolutely vital to note that business investment isn't driven just by the mathematical interest rate. It's also driven by human psychology, specifically expectations. If businesses are highly pessimistic about the future, if they think a massive depression is coming, even an interest rate of 0% might not be enough to stimulate investment. If nobody wants to buy your widgets next year, you aren't going to borrow money to build a new widget factory today, no matter how cheap the loan is. We can't forget the human element.
That leads us perfectly into Section 5, Pitfalls of Monetary Policy, because it's not always a perfect science.
In a textbook, monetary policy looks like a flawless, well-oiled machine. But in the messy real world, executing effective monetary policy faces 3 extremely significant hurdles. Let's break them down. First hurdle, long and variable time lags. The economy doesn't react instantly. It takes months just to gather accurate economic data to realize there's a problem. Then it takes time for the Fed to meet and make a decision. And then crucially, it takes many more months for that policy change to filter its way completely through the banking system to actually change local loan rates and influence consumer behavior. By the time an expansionary policy designed to fix a recession today finally takes effect in the real world, the economy might have already naturally recovered. If the timing is wrong, the Fed could accidentally stimulate an economy that's already booming, creating dangerous inflation. Second hurdle, excess bank reserves. The Fed can magically supply endless money to the banking system, but and this is a huge but, they literally cannot force terrified commercial banks to actually lend that money out to the public during a severe downturn. If banks are scared that borrowers will default, they'll just hoard the cash to protect their own balance sheets. If the banks don't lend, the expansionary policy stalls out completely. It's often described as pushing on a string. Third hurdle, unpredictable velocity of money. The velocity of money is simply the speed at which a single dollar bill changes hands in the economy over a year. If people get scared and start hoarding cash, stuffing it under their mattresses, or leaving it parked in checking accounts, the velocity of money drops plummet. If the money isn't moving, it doesn't matter how much newly printed supply the Fed pumps into the system, the slow velocity effectively cancels out the central bank's efforts.
Truly understanding these complex mechanisms, and perhaps more importantly, understanding their inherent real-world flaws, is exactly what separates a novice from an informed, critical economic thinker. To wrap up our lecture today, I want to leave you with a thought-provoking discussion question based heavily on the pitfalls we just outlined. I want you to really think about this before our next session. Here's the question. If banks choose to hold excess reserves during a recession, driven by a very real fear of widespread loan defaults, how exactly does that defensive behavior impact the effectiveness of the Federal Reserve's expansionary policy? As you formulate your answer, I want you to think carefully about the pathways we charted today, the unpredictable role of human confidence in the market, and the very real physical limits of a central bank's power over private institutions. Thank you for joining this lecture today. Keep reviewing the graphs, keep analyzing the real-world news through this macroeconomic lens, and we'll see you next time.